hi everybody.
Oh, there they go. They got you on.
Everyone's well caffeinated, I hope. I'm Bruce Levine. I'm John Davi's administrative assistant. I also get to run the ETF business here. And thrilled to be able to introduce this panel here of esteemed fixed income folks. Fixed income is really important to us at Astoria. We did our first fixed income fund this year, AGGA. We're big believers in active management in fixed income for many of the reasons you've been hearing about this morning. Statistically, active management in fixed income does far better than active management in equity. And we were really thrilled to partner with one of the panelists here, Brian Novak, in our launch. And we're excited to hear from all these folks. So I have from my left to right, we got Neil Azus, who's the founder of Rareview. We got Brian Novak, who was the CEO of Astoria, and Astoria was just purchased by Beacon Capital. So we're excited to be partnered with Beacon Capital. Nancy Davis, the founder of Quadratic Capital, and Alex Morris, who runs FM Investments and is doing some very interesting stuff he'll tell you about on the tax side. So I'm going to turn it over to you guys. Thanks.
Thank you, Bruce. Thank you, John, for having us here. I appreciate you guys putting us right behind Sherman, Dutta, and Bianco. That's very helpful. This is my first time actually ever being a moderator at a conference, so I'm excited to be here with this panel. Great group of investors who manage billions of dollars collectively, so we'll get some good insight from them. I remember back in 1997, I was going through an undergraduate training program at Goldman Sachs, and at the time, the former CEO, Lloyd Blankfein, who ran global fixed income, came in on the first day and he said, "You date equities, but you marry fixed income." So in that spirit, we're going to find out who our best spouse is over this next few minutes. And we'll start with Brian, the investment consultant at Beacon Capital Management. Why don't you tell us, just spend a minute about who you are, what you do, and number one thing on your mind at the moment.
Number one, or
number two, three, whatever you like. We can be dynamic.
We'll hit it at some point. So again, my name is Brian Novak. I'm an investment consultant with Beacon Capital Management. As Bruce alluded to, I was prior the CEO at Astoria Investment Management out of Chicago for 23 years. And so just to sum it up, been using ETFs across asset allocation portfolios, including fixed income, where we managed unconstrained. I've managed an unconstrained portfolio that utilizes all ETFs. So I get the pleasure of engaging with all of these panelists and everybody to talk about their products and then utilize them in ours. And that was the genesis of AGGA. Again, over time, I've managed strategies ranging from asset allocation to fixed income, unconstrained. And my prior background is I was an equity options trader at the CBOE about 25 years ago. I've managed everything from derivatives and futures-based portfolios to just asset allocation ETF portfolios. So that's how we came to this, and that's why we utilize these strategies. And the one thing that I'm really thankful for is that this industry did a phenomenal job in producing a lot of great active fixed income products, because that was the one thing that was missing. As Neil alluded to, equities have a lot of options. Fixed income was where a lot of white space was, and I think this industry has done a phenomenal job addressing that. You see a lot of players that weren't traditionally in the ETF space that have moved into it and brought their expertise into that. So that's made my job generally as an allocator a lot easier. So I do want to commend everybody here for being thoughtful around that topic.
Nancy, she runs the IVOL fund that you might be familiar with, IVOL. Nancy, tell us a little about what you're up to and your background.
Good morning, everyone. Can you hear me okay? Yes. Well, thank you to Astoria and to John and to Shayna and the team for having me here today. It's great to be here. As you mentioned, I run the IVOL ETF. That's not eyeball, but IVOL, like inflation volatility. So I'm excited to key off of some of the comments that we heard from Mr. Sherman just before the break. And I've been running Quadratic Capital for about 13 years. I founded the firm in 2013. And prior to that, I spent the majority of my career at Goldman Sachs. I was at the firm for a decade, and I was the head of credit, rates, and derivative trading for the global prop team.
Alex.
Last and certainly least, given all this. But first of all, I thank John. And if you were here last year, you know, I usually start these things off by saying we're going to talk about bonds for 40 minutes, so we need to lock the doors. And last year, right as I said that, that wall came down. So John, thanks for doing that a little early off cue this year. But I'm Alex Morris. I look after FM Investments. We sort of boringly, occasionally known as the T-bill folks. We run TBIL and a handful of other ETFs, R-bill, which sits inside of one of the portfolios and looks after ultra short-term tips, sort of germane to what Jeff said. Top of mind for us, I just flew up from Washington, D.C. Today, which is home for me. So if you were paying attention, your bingo card was pretty full of government acronyms and concerns from talks this morning, and those are quite real. Going around town, it's strange to be in a city that is funded by really just the government and have the government not actually working. You'd think traffic was down, it's not. But you know, I think the theme for us and for investors, and you'll hear about and how we're moving our portfolios, is really what does it do when, you know, it's the most important institution for financial assets across the world every day seeks out to erode investor and voter confidence and trust on a daily basis. And we're seeing that play out in real time and in a way that we haven't seen before. So some interesting things, but great news, some opportunity that comes out of that.
I recently just listened to one on a podcast. I forget which one it was, but very great hour if anybody has a chance to listen to Alex. And for those of you who don't know, it's a very large firm with roughly $20 billion in assets now.
You know, $20 billion.
Yeah,
Listen to it before bed if you have insomnia. I assure you it'll be a good cure.
Right. Okay, no particular order. Why don't we just jump into it? We're going to be dynamic here. It's going to be less structured like the previous presentations. If we're priced for somewhere, depending on who you talk to, or if you just like to look at interest rate probabilities, we're priced for about 75 basis points of interest rate cuts between now and the springtime. Where are we going to end this cycle? Where's the terminal rate, or where do you view the neutral rate?
Neutral rate? Well, I think Jay Powell made pretty clear no one knows what it is. The Fed's best models were wildly wrong, and others were somewhere in that range. I think what the Fed has accepted is that it can never actually get to 2%, right? It says that, and then it says we didn't get there, so we're going to redo our forecast, and every few years they just go forward. So we know that's not it. If you believe Stephen Myron, you'd think it's somewhere in the ones, maybe twos, and there's a lot of dynamics as to why that would move. You have to take a big leap of faith that supply and demand always move exactly in lockstep together for that argument to be. I think we're going to see a number higher than we kind of accept and want. That's going to be the high end of the two range. And it's just because historically that's true. We can't, you know, it's going to be hard to acknowledge a three handle. The Fed would have a lot of intervention if that were to be the case. But if you look at the politics of how we get there, but you look at the reality of what the market's given us, this is a 2 3/4 to 3 number.
So maybe some of you are familiar with this movie, Margin Call. I forget what year it came out, but the British actor Jeremy Irons, he says, "Talk to me like I'm a golden retriever." He's the executive. And some people aren't familiar with this term, the neutral rate, but it's the idea of where the economy is not too hot or not too cold, so equilibrium. I think the Fed is currently forecasting it around 3%. They include that in their summary of economic projections every quarter, et cetera. So if we're at 4 1/4 right now, are we really going to get down to 3% and that's the equilibrium level? Or is there a political bias from the administration to reduce it even lower? So I'm going to chime in at the end, but I'm curious if you guys have any opinions, Brian or Nancy. No.
Well, I think the one thing we should all keep in mind is that the Fed just controls the policy rate. So that's the overnight rate. And there's a lot of leverage in the private credit CLO space that Sherman just kind of articulated. And a lot of it is all tied to spread lending on SOFR. So because we have cuts priced in and these loans tend to be 1 to 2 years, there's actually a lot of risk of, you know, kind of the credit contagion and that spread that's currently profitable when borrowing at SOFR plus a little bit might actually go not profitable. And I think that's one thing that I'm pretty excited about is that the yield curve inverted in 2022. So this is when, remember, the Fed was thinking about raising rates. They flipped to be the most hawkish and hike 525 basis points in 12 months, and that caused the yield curve to invert and stay inverted for 3 years. Never happened before in the history of financial markets. Right now, today, the 2s, 10s, SOFR swap curve is 30 basis points. It just went positive in 2025. So I think the question to be asking ourselves is not the neutral rate, or I think it's more the spread, because the spread is all tied to the private equity and all of the levered players. So as the credit curve widens, yield curves steepen, and I think it's just an exciting time with the curve being so incredibly flat, especially relative to Japan and Europe and all these other developed economies that have a much steeper curve than our 30 basis point right now.
Yeah, I'll just dovetail onto what Alex mentioned about that it feels like it's going to be at the higher end of what that expectation is. And if you look at sort of why, what I wrestle with is a duality of what the risks are. And, you know, a couple weeks ago when Chairman Powell came out, was talking about, or when they started to cut rates, and the focus was on the labor market, which is something that we and I have looked at, you know, for 20 plus years as key indicators into what we do. The labor market is weak, and it's going to show weakness. It's going to show further weakness, but it hasn't fallen off that proverbial cliff yet. So let's just take, for example, that is able to stabilize. So if we stabilize there, then on the other side of the coin, which is the inflation component, what happens from there? And there's a lot of indications that we're not getting a big budge out of that side. So if that's the case, what is the Fed left with to do? And if the economy doesn't fall off and continue to slide, because it is the duality of those components, it's a duality in the economy as well, right? There's the tech side of it, and then there's the consumer side of it, the top end of the consumer and the lower end of the consumer. So it's hard to reconcile all these different components and to really try to articulate with great certainty what that final rate is going to end up being. So I think it's just going to be, we're going to have to continue to go and look at this information. But I think all the things that we're talking about, what Nancy talked about, is really what the guys that are looking from the bottom up are focusing on. But from my standpoint, I really think I need to see what's going to happen with the labor market to figure out if we're actually going to be in a continued rate decline or if we're going to stabilize somewhere.
Hey, Brian,
Okay.
I think you make a good point, but here's part of our problem. We're not going to get that information. We don't know when, right? The BLS shut down effectively. You know, it's very convenient if you think the labor market is falling off a cliff to just stop printing the numbers. I know as we talk about Fed independence, as we, you know, 6 months ago, talked about BLS independence, then we lose the BLS head right after a bad print. That, you know, from folks I know in the room, that was less it was a bad print and more of the president wanted to fire Jay Powell. He was told you can't do that. Supreme Court kind of went out of its way to tell you can't do that. So they brought them the next head they could find. CPI delayed. We're going to get a number coming up, right? They call back a lot of people to do this, right? The CPI number is sitting in the BLS today. It's intentionally compartmentalized so it doesn't leak. So they have to bring people in and run the Rube Goldberg machine to compile the numbers, but all the data is sitting there. But we're in this weird spot where now we're not going to get data. And the next few data points we're going to get are going to be knowingly distorted. And then we're going to have to give you knowingly distorted data points afterwards to try to get it back, all to tell you what happened 6 months ago. And you know, the sort of the biggest thing happening at the Fed, the big impact that Steve Myron has had, more so than just the dot that was obviously his, like the least interesting whodunit novel ever in Fed policy, right there, is his desire to turn the Fed towards a forward-looking item, that even though we've got more technology, for some reason we can't seem to get data that's any more accurate or any more realistically faster than we did 2 or 3 decades ago. So maybe we should go to a more forward-looking stance, which, you know, from a central banking experiment that's like the next version of this thing. And I think it scares a lot of the traditional thinkers. And that's where I think the president is going to put the next person. And if you ask, what is the one thing that I think the president wants, it's low rates. The second thing is, I want someone who's willing to look not just what the data has, because the data is often inconvenient. I want someone who's willing to look at what the forecast says, because those may actually be more accurate, but they're also slightly easier to just manipulate. And you see that if you look at the dots over time. There is some herd think that happens there, and the Fed's own internal projections drive a lot of that. I think the president would like if maybe the executive branch could drive some of those policy and some of those forecast decisions too.
Well, just to add on to that real quick. So that,
Neil, we
you're-
won't need you for this. Don't
Yeah,
worry.
yeah. So the reliability quotient is been called into question, which leaves people, the market, to their own designs, right? So I think then where we left off with the labor market, our last interpretation is that it was weak, right? So where do we continue on from there? And I think Powell last week was talking. He definitely can see the numbers. He has more access to data than we do. So he can see that there's definitely the weakness in there. But I think this is all talking towards lower rates, right? But then the question is like and there's other indicators, and I've talked about this with colleagues, that you have to start looking to the state level for claims. You have to start looking through other non-governmental indexes to look at labor market components, whether it be services or manufacturing. But it's a difficult prospect, but I think it's up to us to try to interpolate that, right?
So I'm going to break with the norm here as a moderator and give you an opinion as well, and a shameless plug, and then a hidden secret we found, or what we call a disturbance in the force. We wrote a white paper on our firm at rareviewcapital.com. I think this was back in 2019. We did an analysis of all previous rate cycles to identify what the neutral rate. And it was interesting. What we uncovered was a very simple number or figure. And it basically was wherever the 5-year U.S. Treasury yield went in on the day that they originally hiked the interest rate, which in that period of time was 2.14%, is where it actually ends up, where the neutral rate is at the end of the cycle on the round trip. And it has a 100% accuracy rate. So I'll go out on a limb. I can absolutely be wrong. We can be wrong. We're wrong a lot. However, in this case, we're just very quantitative or statistically driven at our firm, and so we pay a lot of attention to that. So hypothetically, if it's 2.14% and it ends up being that way, and we'll know that in a year or whenever, versus what's priced into the forward market currently around 3%, owning a fixed income instrument will pay you a lot more than what's embedded in the expectations currently. So if that 100% historical rate proves accurate again, you have an opportunity to generate additional total return in that. So it's a decent little white paper that talks about all the statistics if anybody's actually interested in that. And it's, again, what's interesting about that is it's just an uncovered observation. If you go to define models or opinions on what the neutral rate is, there's a lot of different models. And so it's like landing a MiG fighter jet going Mach 2 on a aircraft carrier going 20 knots in big waves in the dark. It's a very challenging exercise. So in our case, we just try to dumb it down to give us some statistical significance to use as a shining light in that darkness. So, okay, so on that same note, since I forgot if it was Neil Dutta or Mr. Bianco, one of them was an inflationist, one of them was on the softer side of that. Not sure where you guys come down, but let's just say hypothetically we get to 3% or whatever the Fed's neutral rate is, or our neutral rate, or what you said. What happens after that? Is the next action a hike or a cut, either based on deflationary forces due to AI and productivity, Trump's manufacturing of the rate lower, or vice versa, inflation actually matters, even though we've all seen what real inflation looks like 4 or 5 years ago? Are they going to raise or cut after that? What's next? I'll let anybody start if they have an answer for that.
Well, I just say I think trying to speculate on the hike, cut, when, how much. I mean, the market's routinely just gotten that wrong. In 2024, we started the year expecting 6 cuts from the Fed that didn't materialize. So I think the thing that, at the end of the day, close your eyes. What are your concerns? Your concerns are, what type of duration risks do you have in your bond portfolio? So the Fed, cutting, hiking, whatever the timing is, it's really a question more to me of the yield curve and what exposure you have. Because again, the Fed only controls that overnight rate. So to me, I think it's really a question of what does the rest of the world do with our debt? Because right now we've had QT kind of announce that it's going to be ending. We have China and Japan as the largest owners of our treasury bonds outside of the Fed. And I think it's really a question of what is the supply-demand dynamic going to look like, especially as tariffs potentially heat up. And I think to Alex's point earlier about the data the really interesting thing to me is that the interest rate, my specialty is interest rate volatility, and a lot of the interest rate volatility traders on the sell side have, never seen kind of a period of risk off without, maybe a hot second during the COVID sell-off. And because the data has been delayed and hidden, it's actually made the price of implied interest rate volatility fall, which is really interesting to me because it's sort of a close your eyes, keep calm and sell vol. And there's a whole wave of institutional vol sellers through the QIS products, which I'm sure probably many of you have been pitched from the sell side. And yeah, it's just a very, very interesting time because interest rate volatility, our type of interest rate volatility, is trading at 3 basis points a day, which, 3 basis points a day, you kind of, does it really matter which way interest rates move? You just want it to move more than 3. So.
Right. Okay, so with that in mind, let's talk about our favorite asset class within fixed income, or our favorite view. I'll start in our fixed income funds, trying to keep life really simple. I think of the world with 3 speed governors, the U.S. dollar, the crude oil or the barrel, and then U.S. interest rates. If all 3 of them are trying to be manufactured down or biased down, immediately I think of emerging markets, and then I think of emerging market debt, and then I think of emerging market debt with the highest real interest rates in the world being Brazil, Turkey, I'm sure one other one, India, things like that. So we have an overweight bias of emerging market debt in most of our fixed income funds, which as Richard Sherman showed previously on his bar charts has served us well this year, and we think that will continue. Anybody have a view on what they've got? I know all of you look at all sorts of different things.
I mean, put aside individual countries, which I do think once you start playing that game, you need to take a look at Washington, D.C. and ask, well, what's its policy? Jeff showed a pretty good idea that the world follow. We kind of rise together, we fall together, right? We hike together, we cut together. But this is the first time that we're hearing the U.S. government isn't going to pick winners and losers internally, which, there's been accusations that regulators and other policies have really sought to do that. But we are made very clear, we will pick winners and losers in the geopolitical spectrum. And it's no longer just our friends who are the winners and our enemies who are the losers. It seems to be that the way we're reshaping tariff policy, trade policy, but also just diplomatic policy is changing. So as you start to look at some of the numerics that may work out for you, you do have to take a step back and wonder, that may be true today, but what used to take 6 months to 6 years to change from a policy standpoint now hinges on a tweet. And it's very real, and it's a very strange dynamic, particularly in some of the countries who have played this particularly well. Pakistan comes to mind, has done a great job playing the president's mentality against itself to their advantage, where some of our friends have come out looking not so great. I mean, the president seems to go out of his way to disparage Spain, who's a founding NATO member, for a great deal of time. And there might be some truth to some of his arguments, but not to the fact that we need that alliance more than maybe some of that alliance needs us.
Alex raises a great point. Every 10 years or so in the bond market or the sovereign bond market, there's an event that you can actually get paid on that you wouldn't think you get paid on, and it's a big surprise. So I always think of tobacco bonds, which were, I think, remember, $100 billion or $200 billion settlement. One day you woke up, if they were inside one of your closed-end funds somewhere, they quadrupled, and you said, hey, how come I'm up 2% today in a bond fund when you couldn't really tell? Or more recently, Puerto Rican bonds at some point had a big re-rating that you can get your hands on. So at least in our discussions and how we're positioned, I believe we have 10,000 troops in Puerto Rico right now. I imagine Venezuela bonds trading at 8 cents on the dollar. If something were to change there, that may be worth 40 or 50 cents, assuming they don't get, there's a technical term called repudiation moratorium where they're put back. But assuming they are restructured, there may be an opportunity there. I'm just not sure if you're going to get a chance to own them or you can find them, but that comes to mind on the geopolicy or the geopolitics of sovereign debt investing and how quickly that could change based on a tweet.
And with repudiation moratorium, you punch my bingo card of phrases for the day, so thank you.
Exactly.
But I do think there's this sort of other thing which, there's a really big divide between Washington and Wall Street. And for a long while, growth was so good, numbers so good, it didn't much matter. But that divide is growing by the day. Europeans have dealt with this a long time. Certainly, if they have Brussels versus their home continent, home capitals, and then within their home capitals and themselves trying to figure out what to do. But there's going to be a lot more of this. I think you're going to hear more about this. The administration is just ramping up. Despite all the headlines and all the changes in policy, you'd expect this to be the end of 4 years. But indeed, it's just very much the beginning. Midterms are coming up. There's redistricting happening that seems like it might hand more power to a very strong executive. And I think most investors here have been used to a relatively docile time. And although you hear a lot of rhetoric, the reality is most policies have all kind of headed towards the middle and been pushing up equity markets, broadly speaking. That is no longer true. And as you look at positioning your portfolio, the one thing that, to maybe give you something to take away from today is the reason why, in particular, bonds and ETFs work really well is you can move quickly. A lot of these ideas that we'll talk about from a sovereign rates policy, from a credit policy, where you want to sit, it's actually kind of hard to move in size into those portfolios quickly. But the ETF world makes that very simple. And it gives you this sort of inherent immediate liquidity where you get to turn a lot of market makers into your trading desk for you, which is important because, like I said, it used to take 6 months to 6 years for policy to happen, and now it takes fractions of a second. And if you go back to first, second quarter of the year, which was like a dog year for those of us on the desk, you could see 20 percentage points of range on a day, all happening in the course of 2 minutes.
What's the old quote? Liquidity is only available when you don't need it.
Exactly.
Brian, what are you seeing these days?
Yeah,
What do you like?
So just, I stay out of the nuance because that's what these guys are good at, but just looking at it, because my job is to construct sort of where are we going on duration, where are we going on credit, and I got to approach this with a bit of humility because I got to be honest, I didn't see the long end moving down as much as it has this year. I was having a conversation last night just about the 60-40 portfolio, including equities here for a minute, because why not? That, like, it's done remarkably well. I'm surprised at how well duration is actually done. But with that being said, it's like you don't have to be, it's not absolute. You don't have to be wrong if you're just not in the position. But I continue to favor, I didn't like it at higher levels. I'm not a big fan. Continuing where we are right now, data aside, because I think that we've had a good move. I mean, if we're looking out for the next quarter, we're at 4%-ish on the 10-year. Like, I think we've had a good particular move there. I think we're going to need to see some more things transpire to affect where that ultimately goes. But right now, like, I don't want to mess around with longer duration positions. I think there's still opportunity at the intermediate to shorter end of the curve. But I think another thing that as we look through, because we're starting to see some minor issues and tweaks within the credit markets, I've had a bone to pick there for quite a while, but I continue to talk to more experts to get more information in that particular area. But if we're going to see some things like this start to pilfer through, because we've been pretty well priced with credit spreads, I do like investment grade. I like higher quality on the shorter duration side, and that's just an asset allocation play, because I think that where we've moved with duration, we run a risk of that going back the other way, and I do worry about some things in the credit markets right now. And I think you just get a lot of duration risk in credit right now because spreads are so compressed. So you're getting more return from duration and high yield than you have in quite a while. So I think it's better to be a little bit shorter duration.
So I just recently read a thoughtful paper, if anybody wants to talk about it after this, but there was an argument that as tight as credit is that it may be able to trade through treasuries during this cycle, just given the magnitude of the Magnificent Seven, et cetera, and what they're doing, and that there's still a lot of spread tightening to go if you can take that view. So there's one of those. Tell me, I'm going to switch gears here for a second, just ask some random questions. What signals or signs would you want to see that the AI trade or any of the themes that are going on would be required to disrupt what's working? So for those who haven't been following, a multi-asset portfolio, stocks, bonds, cash, corporate credit, and commodities is up around 17% this year versus 60-40, somewhere between 8 and 12, depending on whether it's domestic or U.S. The train has left the station on anything that has a price on it. What could derail that to you guys?
Jobs, I would say jobs. Yeah, I had dinner a week ago with a bunch of senior women, which was amazing. But one of them, without naming names, has 15,000 direct reports, and her mandate is to cut 30% of her workforce over the next year due to AI. I've been volunteering at various universities. Really, Cornell was my original one in the financial engineering school since 2011. These students have no internships, no jobs. It's a desert out there. So I think the thing about AI, there's so much productivity boost, but at the same time, we could really see, the Fed does have a dual mandate. I definitely agree, with Jeff's comment about the CPI is kind of a made-up number at 2%. Definitely agree with that. But I think the jobs numbers could get really, really atrocious, especially with this government shutdown and potential furloughs turning into job losses. So I think it's a potential jobs recession could be what we're looking at longer term.
I think the other derailment, aside from the impact, is I've yet to see a really compelling business model for how these companies actually monetize this in the long run. So they may be their own undoing, and there's a lot of aspiration, to Nancy's point, to cut a third of your staff because of a two-letter acronym that has yet to really define how it's going to do that. And don't get me wrong, if you go to ChatGPT, you get some pretty amazing things, or go to Claude and magically we're all Python coders now, and we've got this great way to do that. But I've yet to really see that business model that says this is how this is going to be sustainable for the companies who are going to make those job cuts, because those one-time job cuts are great, but the market's going to expect to see that efficiency continue and trade through a cycle. And two, that those companies can actually all realistically put all that CapEx to work and turn that into a reliable revenue stream. Because cutting a third of your staff, but how much of that has to go back to AI Co to make it worth their while to run that for you?
So just a comment on that. I'm not an expert in any of these kinds of things, but the yardsticks or the math that I've heard over the years is that if the S&P 500 operating margin right now is 13%, 1% change, so going from 13 to 14%, equates to about 20% in the index price. So if all of this AI and all of this CapEx spending changes that, there's a lot of runway. And the way I'm just sort of sitting back humbly and thinking about this is, if it took us 100 years to get $1 trillion of CapEx in the Fortune 500, and now 2027 is forecast to have $2 trillion, and 2030 is supposed to have $3 trillion, somewhere in that whole process, we're going to be sticking 10 pounds of bologna in a 2-pound bag. And if any of that translates to any productivity, minus the impact on consumption and the consumer, of course, or unemployment, it just seems like there's a lot of room to go for margin expansion. And just on that alone, seems like a lot of index performance. So I guess when I hear those kinds of things, I want to appreciate that. I want to be very mindful. I'm just thinking about the other side of the equation, to not lose sight of the long term on owning at least the index.
Yeah, I've got an analogy. So I was at like years ago at the Caltech robotics lab, and we were watching some phenomenal things going on with the robotics and the automation they had out there. But the one thing that always stuck with me, I bring up pretty regularly, is that the professor was talking about. He's like, getting from here to here takes what's called a day. Going from automation to autonomy is a whole different story, and it takes your margin of error has got to be zero, right? So there's a big gap between going what Alex said before, and I saw some stats on this about the productivity of AI, that large businesses are actually seeing an uptick, but I think their implementation is about 14 to 15%. If I might be wrong, but it's about that. Smaller businesses is actually tailing down. It's about 7%. So there's not a large uptake in terms of the usability of the actual technology. And I'm a big believer in sort of techno-economic evolutions and things like that. And if we remember, back in 2000, we laid a ton of dark fiber that didn't get used for 10 to 15 years, but it was there. So there's boom and bust cycles and all these things, and to expect this to be a perpetually logarithmic move, I think is unachievable. So I think there's going to be some disruption, and if we were to get some weakness in those labor numbers, I think that would accelerate that decline. I saw some numbers about Microsoft's CapEx spending was actually supposed to be year on year down from the growth rate, but it's still hyperbolic, right?
The absolute numbers.
The absolute numbers are crazy.
So last subject, we have a couple of minutes. I'll try to keep this one brief. So a lot of people have seen the recent asset allocation call. I think it was from Morgan Stanley about the 60-40 portfolio becoming 60-40-20. So, sorry, 60-20-20, stocks, bonds, and gold. So bonds here on this panel losing 20% of our luster for gold. For anybody that's followed myself or our firm for a long time, we have not had a lot of love for gold until a catalyst occurred several years ago when Russia invaded the Ukraine and their reserves were confiscated by the United States. And the exercise began where all of these different sovereigns began stockpiling gold. And most recently, we just learned that it's not just Russia who bought 20 tons of gold in Q2. We don't have Q3 data yet, but Tether, believe it or not, bought 19 tons of gold. And so there's another elephant buyer in the world. And the argument or the theory goes in China right now is that they want to move from an active tier one asset of gold, I'm sorry, a passive tier one asset of gold to a active collateralized assets for their $17 trillion repo system there, and then also use it as collateral for their trade finance. And they're setting up the stages for that in Hong Kong to be able to make that fungible and trackable. Anyway, long story short is if you bring your reserves up from where they're at right now at 7% of gold in their reserves to an average amount around 15 to 20 to be able to call yourself a reserve, that's a lot of gold. It's like 3 or 4 trillion. So call that, I don't know, 7 to 10 years of supply that needs to be an ongoing buyer. Are any of you guys, very briefly, subscribers, and at what size do you need to put gold in your portfolio and not think about it as I'm selling something else to buy it right now that's moving faster, but it's got a structural tailwind at its back?
In short, we've been pro-gold for a long time. Mutual friend of Nancy and mine has always put it should be the 25 rule, 25% international equities, 25% domestic equities, 25% bonds, 25% gold.
So a large allocation.
And it's
Very nice.
paid off.
Very good year.
I've maintained for decades I have no opinion on gold. I don't.
Do you put it in portfolios?
On momentum for commodity models in the past, yes, but it's mostly been
You're model-driven.
on model-driven stuff.
Okay.
Yeah.
Nancy, how do you feel about gold taking our business?
Well, does anyone in this room know Jim Rickards? He's a big gold bug. And I was pretty amazed because he recently reached out to our firm and he put IVOL in their portfolio. So I don't know about gold, but I did think it was very interesting that one of the biggest gold bugs out there is buying inflation expectations outside of CPI.
That's a good answer.
Yeah,
Appreciate
it's
that.
true.
Yeah, good backdoor way to get
Last week.
compliment that. Okay, thank you. I think that takes up our time. Thank you, everybody, for being here and listening to our panel.
Thank you.
Appreciate it. Great to be here with you guys.
Thank you, sir.